Hello and happy Thanksgiving to all of our viewers. It is November 21st of 2022. And of course, it is Thanksgiving this week. And, we're definitely grateful and thankful for all of our clients and our family and what's certainly been a challenging year across global markets. But rest assured that as we continue to churn our way through this potentially recessionary storm, that we're going to be here with you every step of the way. Now, as it relates to the overall market, last week was a relatively quiet week, and it's a nice change. Whether you're talking dramatically down or dramatically up, the big swings, I think, unsettle a lot of investors, a lot of people in general, questioning what on earth is actually going on. So for the first time in a long time, we had a relatively quiet week. Now, that said, that doesn't mean we didn't have a lot of important developments, and we're going to go through all of those this week. Now, the title of this week's presentation is The Lost Decade, with a question mark, because, of course, getting the week to week, the month to month, the quarter to quarter is hard enough, let alone what's going to happen in the next 10 years. But what we do believe is happening is that this dramatic inversion in the bond market yield curve is signaling a long-term regime shift by the Federal Reserve. And what is that regime shift all about? It's about taking liquidity out of the system, an end to the era of easy money and structurally higher interest rates, not just this year, but for the foreseeable future. So we're going to go over three key components this week. First, how to navigate a potential lost decade. Number two, understanding what an inverted yield curve actually means. We're hearing a lot more about it. We were kind of early on to that, but we're hearing more and more about it. Number three, reviewing the spread between implied and realized volatility and how that can help us manage the portfolio over a short period of time. Now, the big three things that we want to pay attention to this week: thriving during a lost decade, that yield curve inversion, and overall implied volatility discounts. Those are the three key concepts that we really, really need to pay attention to here over the next couple of months. And the lost decade is this concept of the overall index, not stocks at an individual level or sectors at an individual level, but the overall index, such as the S&P 500, the NASDAQ, or the Dow Jones, essentially generating a flat return over the next 10 years. When did we last see that? We last saw that between 2000 and 2010. This is the index here, and you can see over about a 10-year period, the indexes really didn't do anything, but they did have a lot of volatility. Now, why was that? We were unwinding a very large liquidity bubble that took place in the year 2000 and the years prior, known as the dot-com bubble. We see here the six largest weights in the market: Microsoft, Cisco, Walmart, Intel, Nokia, and IBM, made up over 15% of the index. And this is an important concept, and here's why. Because the index is market cap weighted. So as those very large components of the index start to unwind and become smaller companies, they act as a headwind on the overall index performance. And so since these six names were such a large weight of the overall index, they acted as a drag. Now, let's compare that to today. Today, we have Apple, Microsoft, Google, Amazon, Tesla, and Meta. Together, they're not over 15%. They're close to 30% of the index at their peak. So we do believe as technology continues to unwind and the valuations from those tech stocks continue to unwind, that is going to act as a major drag on index investors over the next 10 years. Not because there's anything wrong with passive investing. We do believe in long-term investing. But the way that the indexes are constructed put index investors at a structural disadvantage relative to active investors during a period where the largest stocks are unwinding and ceding market share to the average stock. And I think that's a very important concept. The top of the market, we believe, is going to underperform the average stock within the S&P 500. So how do we thrive during this time period? Three key themes I think are going to be important. active over passive, the ability to overweight sectors that are not the biggest components of the overall market. The average stock, we believe, will outperform the largest stocks, and the old economy will likely, in our opinion, outperform the new economy. We believe these are the keys to success in the 2020s. Now, the big warning signal, we've been saying this for a really, really long time, is the yield curve. The 2-10 yield curve, the 3-month 10 yield curve, the 3-month 5-year yield curve, you name it, we're having very significant inversions taking place across the bond market. The yield curve has not been this inverted in over 40 years, since 1981. And this has generally preceded not just a recession, but actually a fairly deep recession. And this is what's given us pause. This is why we're cautious in the portfolios. This is why we're net short in the portfolios. And yes, just because we have, there's a week here or a week there where the market goes up and we don't because we're short, we're not going to chase the market higher because there's a garbage trade going on for a few days as people are short covering. This is telling us something is wrong in the system, and we want to be really careful about that. And in addition to the yield curve inversion, this particular yield curve inversion cycle has seen more rate hikes during this inversion than any other inversion that we've seen in the past. So if we go back to the mid-1980s when the yield curve inverted, there was about 137 basis points of Federal Reserve rate hikes. 2000 to 2001, about 1%. 2006 to 2007, another 1%. This time around, it's 350 basis points and counting, so 3.5% and counting. We're likely to get another 50 here in December, which will take that up to 4%. So what was our key concept from weeks prior? That the Federal Reserve is hiking rates into a potential recession. This lines up perfectly with hiking into an increasingly inverted yield curve. This is one of the scariest things that we see in the market right now. Now, does that mean markets can't go up at all during yield curve inversions? Absolutely not. If you toss a cat down the stairs, it's going to bounce on its way to the bottom, right? And I know that's the imagery of that is not the greatest, but it's important of this concept we call dead cat bounce in the markets. And so, we look at the 1969 example of a 310 a yield curve inversion, or we look at the 1973 to 1974 example of a yield curve inversion. We got many short-term rallies. In this case, we had an 8% rally, a 10% rally, an 11% rally, another 10% rally on our way to new lows. So what's the message here? Don't chase these short-term returns where garbage stocks are leading quality stocks because people are short covering for fear of missing a market bottom. When the yield curve is this inverted, it's a sign to be careful not to take a ton of risk. Now, just for our home gamers out there, right now the current rally in the S&P around 10 to 11%. So just keep that in mind there as we look at those historical comparisons. Now, we're making this question of what Fed pivot. James Bullard came out on Friday and said, listen, not only are we not done hiking rates, I think this was actually on Thursday, pardon me, we think rates may have to go to 7%. 7. We're in the low 4s right now. 7. And people are talking about pivoting. And James Bullard, mind you, is one of the more hawkish members of the FOMC. But the fact that he's even throwing 5 to 7% out there, I think should be a reality check. Are 7% rates in your models? That's what we ask people both on Wall Street and on Main Street. Are 7% rates in your assumptions? And we would argue probably not. Now, from a short-term perspective, another thing that's given us real pause here is that the implied volatility discount relative to realized volatility. Now, let me explain that. Implied volatility is volatility that the market expects in the future, 1 month out, 3 months out, versus present. Those are at significant discounts. We see minus 18%, minus 20% discounts on the NASDAQ, small caps at minus 15%, Why is this important? When protection, there's not a lot of demand for protection 1 month forward relative to the present, that's usually from a trading perspective, a sign that the short-term momentum of a previous rally could soon peter out. So if we look at historically where these discounts have occurred, the last one was, of course, right there in March of 2000. We look at there in January of 2020, right before the big sell-off there due to COVID. So we haven't had this amount of 2 sigma cheap implied volatility hedges relative to realized volatility hedges since prior to COVID in January of 2020. The other thing I do want to point people out to are the amount of flows, investor inflows into high yield bonds over the last month. This is extreme. This is, in our opinion, a deep contrarian signal. So we want to be careful. Don't go chasing these flows into high yield bonds, into the riskiest corners of the market because people are short covering. We do believe that it's a time to be careful. We see that in the leading index of economic indicators. So this index looks at the composition of the average work week hours, jobless claims, new orders across ISM, both service and manufacturing, building permits, the credit markets, yield spreads as we looked at before, and of course, consumer spending expectations. This is at its lowest level in close to a decade. And this has a leading component to it. In other words, we historically has led the market. So again, we want to be careful here, not trying to chase these rallies. And we see it in the data. Home builder sentiment, off a cliff. We look at Empire Manufacturing new orders, off a cliff. These are not, and I repeat, these are not soft landing pictures. These are hard landing pictures. And I want to be very, very blunt about that. When we look at this data, we don't look at the data and say, wow, this looks like a nice soft landing the Fed has orchestrated. This looks like a hard landing. I just want to be very clear about that. And so when we're designing the portfolios and we're looking at asset allocation, this is why we're careful. Does that mean the market's going to go down on Monday? No. It could go up. It could go up Monday and Tuesday. That's not why we invest, right? When we look at last year, one of the big mistakes we made last year was not giving our energy trade enough oxygen to breathe. We're not going to make that mistake again. And so right now, it's a time to be careful. So what's the bottom line here, ladies and gentlemen? The yield curve is signaling, in our opinion, a generational shift in how the Fed treats the cost of capital. And the bottom line, don't fight the Fed. We believe the bond market is signaling the potential for a deep recession. And the good news is that the bear market rally has given investors an opportunity to sell a lot of those unwanted junkier assets that you might have been stuck with 2 or 3 months ago. Take the advantage, use the window to sell at a higher price. We definitely encourage that. Lastly, we do see leading economic indicators starting to roll over. That's a big red flag, a sign of caution, and we really urge clients to be careful here. We really do, especially going into the holiday season. So that's what we got for you this week. 888-543-3776 is our number. Please reach out to your local advisor if you have any questions, and have an absolutely great, fun, safe, and fantastic Thanksgiving. Thank you again, and have a great week.